Welcome to The Missing Link, a podcast where crypto and insurance come together. I'm Dan Roberts, and my co-host is Danielle Wall-Elliott. Whether you're in crypto, traditional finance, or in need of a new podcast, The Missing Link will help you explore the vital role that insurance plays in crypto and how blockchain will disrupt insurance. Join us on our journey to find the missing link. Hello everyone, today we have Alex Thorn from Galaxy Digital. It was a fantastic discussion. We go over, are we really in a bear market? Where is VC money going? And do VCs need a different knowledge set to invest in protocol level startups? He tells us a great story on how Wall Street was underwater with paperwork, which drove a centralized solution. So if only blockchain was around back then. His focus on research is really evident during this conversation, so certainly not one to miss. We hope you enjoy it.
All right. Welcome to The Missing Link, Alex. We're so glad you are here. Alex is Managing Director and Head of Firmwide Research at Galaxy Digital. If you don't know, Galaxy has 5 business areas: trading, asset management, investment banking, mining, and venture, with almost $2 billion in assets under management. Wow. Across your active and passive strategies. Alex is also the host of Galaxy Brains, a podcast. So we're turning the tables on him today. Before he worked at Galaxy, he spent more than a decade at Fidelity Investments and worked in the Bitcoin and blockchain focused venture capital over there before joining Galaxy in 2021. Alex, welcome. Is there anything I missed that you want to share with our listeners about yourself?
No, that is my entire life story, Danielle. Thank you so much for having me. No, I'm really excited. I'm hearing it and they say, if you don't know about Galaxy, just go to galaxy.com. All right. We got it. We got that good domain name about a year ago. We had been galaxydigital.io for years, but now we're galaxy.com. Samsung phone, eat your heart out. And there's plenty of good content there, including all of my team's great research.
That's great. Well, first I wanted to chat about the podcast. So congrats on the success. You've had quite the heavy hitters over there. A lot of hot hot guests that I have loved to listen to, as well as, each time doing a trading take at the beginning. So a little, lay of the land in the market. So I was wondering, this is episode 4. Do you have any advice for us on how, best to get those guests, get those hot topics and hot takes?
Oh man, that's a good question. Honestly, we just kept our head down and just did it every week. And when there was 100 people listening in like weeks 1 and 2, like we said, we're just going to keep doing it anyway. And, don't do what everyone else is doing. For example, I was thinking, we have our director of principal trading, Bimnet Abibi, come on every week and basically give us the pulse of Wall Street. So he throws in some of his views, but a lot of what he's telling us is like what the market is literally saying, right? To give us an update on how Wall Street is pricing various Federal Reserve rate outcomes, for example, right? That's just Wall Street consensus that he's explaining to us. And I thought maybe we should do here's a list of all the crypto news that happened in the last week and run down that. Some of my favorite podcasts in crypto do that, but everyone does that. Literally right. Everyone does that. Not everyone has the man who's trading our own book come and tell us what's happening on the street. So we decided to go. So long story short, I would say, persevere, and do something different.
Well, speaking of something different that you do on the podcast is starting with a rap every time. I did, I tried to write one. I had ChatGPT, write one about you. I'm not brave enough to do it. I thought about it, but I wanted to ask you. Come on, throw it down, ChatGPT. I wanted to ask you, why you do that or what motivates you to start each time with a rap?
It's honestly a really great question. The why question being the really great question. Why do we rap at the beginning of the podcast? I don't know. I'm looking over at my producer Phineas here, who's here, and we joke about this question sometimes. And we're just like, why not? I have hundreds of beats. I made all of the music that we use that I've never had any real, I've recorded some of my own stuff, but never had any real use for it. So I'm like, okay, well, we've got the music, and I've been rapping since I was 12, so I'm pretty old. So that was a long time ago. It was more than 20 years ago. So, these are pretty simple raps. I use pretty much the same rhyme scheme every time because we always start it with the weekly podcast from Galaxy Research. So I don't know. The simplest answer was because we can, and people seem to like it, and it's fun, and it's funny, and it's different. So that's really the answer. But there's no
someone
real
gave
good
you a
reason to
microphone.
why. Yeah, exactly. It's like, if you put me in the room with a microphone and I got a producer who can load up some beats, like it's going to be a pretty short amount of time between when we start going with the podcast to like, well, should we just like be rapping right now?
At the age of 12, did you want to be a rapper on the big stage?
I didn't want to be, no, not really. But I did really enjoy it. And I had some friends and we all did it. And I mean, I've friends from growing up will, if they see this podcast, will have a lot of, will know very well that I've been rapping for a long time, all throughout like high school in particular. I don't think I ever really wanted to be actually a performing rapper. And like I said, I started making music.
You get more listeners on the podcast. You're gonna be getting recruited. It's amazing to have you, Alex.
Thank you. Guys.
A recent tweet of yours was, which I'll quote: "Investment is down, valuations are down, VC fundraisers are down. Learn why, view all the data, and learn what the future holds." And I feel like what comes from that is that during these, how do we call it? Somber, down, bearish times. Data really is your friend, and data is your friend all the time, I imagine. But particularly so during these kinds of cycles. So, you've been putting a lot of research out. Galaxy Digital, has a heavy focus on research, which you lead. Perhaps you could summarize, I'm sure is a difficult task, but summarize not just what some of these findings are, but how you guys use data to make good decisions, to educate, and perhaps a nod to what might be coming down the line based on this data. Yeah.
So Dan, you're referring to our venture capital report, which we put out every quarter. So this is the Q1 look back. We're looking back at the last 3 months. Could do this monthly, but I was just like, we're going to set it at quarterly. Like, I don't want to write this if I do it monthly, I have to write this report like every 3 weeks. We put this out every quarter, and we put it out. The fourth quarter one is the annual one, right? So in January, we put out one summarizing all of 22. The data now, so we're talking about investment in crypto focused startups. Which I think is an important metric to understand, and for where the space is going. I mean, really interestingly, if you go back and you look at all the companies that were founded in 2018, right after the last blow off top in 2017, right, the last bull market, you're going to find like Fireblocks, you're going to find all the lending companies, you're going to find all the institutional custodians, like giant amount of, you're going to find Galaxy. I mean, Galaxy was basically founded in the very beginning of 2018. That whole run up was on the back of like Bitfinex and Poloniex in the US, right? And a little bit of Coinbase. Coinbase only traded like one asset at that point. Mm-hmm. They might have gotten up to 4. I think they had gotten up to 4 by the end. So they had Bitcoin, Litecoin, ETH, and and maybe like XRP, right? Now they trade hundreds of assets. So that entire bull run in 2017 was built on very flimsy and immature market infrastructure. And a lot of people came into the space, and some of them stayed even after that bubble popped, and some of those people became true believers, and some of those people were entrepreneurs who founded companies. And there was a lot of opportunity for those smart people to say, wait a second, like we went to $20,000 on Bitcoin with not a single institutional custodian, not even one, right? There's a lot of in very immature capital markets, no way for institutional lending to happen, for example. So a lot of those startups, which were early stage in 2018, are big companies we know today. And I focus solely on the market infrastructure example, because that was a huge. Those were boom times for market infrastructure crypto startups, 2018 to 2020, right? And you could see that then when you looked at this data. And so that's why that's one in terms of gleaning insights and helping to formulate strategies based on this data. That's something we always look at, right? I always look at where the heat is for early stage companies. What are people building? What are people funding at the earliest stage? And, some of them are going to end up being stupid. Many of the companies will end up failing. That's a given in early stage investing. But some of even the ideas will not pan out, right? But some will hit, and there will be companies that we identify as pre-seed in 2023, Q1 2023, that in 3 years are unicorns. 2 years are extremely important, right? So that's why we look at it, and it helps us understand like where the space could go, right? Because we're seeing now. We also, as Danielle mentioned, we have a big venture operation at Galaxy, and so this is all important for us to understand like what the trends are there too. So that's the answer, I think, Dan, on the venture specific. I mean, but if you want, we can talk more about just data and using data for insights more broadly.
Well, I want to, I want to just, back in the day, my big hot take was like, oh, cloud storage, like that is going to on-chain storage. I had storage, I had SIA, I had, all these coins. I just kind of made this, rather than bet on one, I was like, oh, I want to bet on all of them. So, but I don't feel like that ever really, it didn't take off at that time. Maybe it's, still waiting around. But are you finding, are you saying that infrastructure is kind of that piece that you're, this larger pot that you're trying to look at, multiple companies in, or can you even break that down into a smaller, area?
Yeah, I mean, I think infrastructure is always one of them. Market infrastructure, though, is much more advanced today than it was in 2018. So in particular, for on the market side, there's much less opportunity, I would say, to, we have derivatives exchanges, we have custodians, we have lenders, I think there's some that we still want. I mean, I want a better settlement network, a way, you think about in traditional markets, right? You don't have to move your Apple stock to the New York Stock Exchange in order to sell it, right? So I think the market is always looking for that. There's reasons why we don't have a great one of those yet. But so there are opportunities there. I think what I'm really thinking is that the opportunities now are different than they were then. And just on file storage, like on the decentralized file storage question, they're still out there. And I think there's actually a great startup that I like that's also from the Boston area called Filebase, like Coinbase, Filebase. Check them out because they make it really easy to interact with SIA or Filecoin or storage without really having to. Like they handle it for you. It's actually really a cool thing, and I believe it's like the economics are better. So like it could even.
I'll definitely check it out. I kind of give it up for a while. So
yeah, I just mean if you're interested in that.
Yeah.
But what we found on this report and what we've been tracking, and it won't be a surprise to people that are, that follow crypto. The big sectors now. You still have we sort of group these into categories, right? The companies, and these are a little bit arbitrary. It's just our subjective categorization of crypto startups, right? So, I mean, someone else could say, no, that's not really DeFi. That's like layer 2 or whatever, right? Like, and come up with slightly different data, but we do it ourselves and we try to keep the same methodology. So at least you can look at our tracking of it over time. And the two biggest categories for investment last year are basically trading, what we call trading, exchange, investing, lending, as in like all of the market infrastructure type stuff, everything from exchanges to, a lending company to any kind of company that helps people invest in digital assets, right? Like retail facing, whatever it is. That's been the biggest category historically. Prior to basically the last bull run, the only unicorns in crypto were basically mining machine manufacturing companies, right? Like Bitmain, or exchanges. Those were the only valuable companies. But last year and the year before, I mean, we really started to see Web3 related stuff become very popular, right? And certainly a lot of deals and a lot of companies, but also a lot of money invested. And then think about it, like you had OpenSea as a great example, right? Okay, I guess it is kind of an exchange, but we put NFTs, DAOs, metaverse related stuff in this Web3 category. And there's a lot of those companies. And then there were there's gaming companies that became pretty big. So I would say sort of the over the last few years, right? And that category just didn't exist in 2018, right? I mean, there were, CryptoPunks, I think, launched in 2017. You had
crypto kitties.
You had the kitties. Yeah. I mean, so there were like NFTs but nobody cared about them back then. Obviously, the NFTs go back even further, right? I mean, the first NFTs were on Bitcoin, but it wasn't like a scaled, interesting thing, right? Whereas it became one over the last 2 years. So now you can see, I mean, I'm looking at the number of deals, right? And Web3 is the biggest share from Q1. Most number of deals are for companies in that category, right? So, and they tend to be much earlier stage than the companies that are the trading related companies, right? So it's earlier money, which means it's, potentially newer and more innovative ideas. So, whether that's going to stick around, whether we're going to get like, $1 billion DAO tooling company, I don't know, but it's like that. The market is telling us to pay attention to that segment.
Right. I mean, when, with your venture hat on, when you look at what is being funded at the very early stages, how much do you pay attention to the existing now established infrastructure plays, your custodians and exchanges that have done well over the past, 3-4 years? Because surely they're looking to implement, more new features and new innovations within their kind of heavy pockets, or do you purely focus on where the sort of broad VC market is allocating capital into early stage companies?
Yeah, I mean, we definitely look at both. I think the capital allocation to later stage companies isn't as high signal. I mean, we know that they have a product or whatever, depending on what it is, right? But I think an interesting thing to think about is where that capital is coming from. Because that's the other sort of side of this coin that we cover in these reports is the fundraising side. So the venture funds fundraising, right? So you've got them investing, the funds that do the investing, the capital investment in the startups, but you've got the allocators investing money in the funds, right? And, for late stage companies to raise money requires a lot of capital, right? I mean, we're talking about many times hundreds of millions of dollars sized rounds, right? And where's that money come from, right? I mean, there was only 2.4 billion total allocated to startups in Q1 of this year. I mean, might sound like a lot of money, but I mean, we were well over 10 billion for multiple quarters, right? In 22 and 21 and 22. So, if you're a late stage company and you need to raise like a couple hundred million, like that ends up being a massive percentage of the total amount allocated that quarter. You need growth stage venture to do that. And they've left, like the traditional generalist VCs that came in, like they are really not active right now. So you've got crypto funds, most of which are much smaller than like, Tiger Global or like these giant VC funds. And so they can't really support, putting hundreds of millions of dollars, and there's maybe one or two who can, right? There's some couple really big crypto VCs, but like I can count them on my hand, right? There's not many. To me,
what do we need to do to get those big guys back in?
Yeah, well, we got to not have like giant venture-backed spectacular blowups. I mean, that would help. That's one of the main issues, right? I mean, a lot of them invested in FTX, some of the lending companies that didn't do well, and they feel burned. I mean, I think, and rightly so. That would help. But also you have to understand too, like, I mean, we write about this in the report a bit. I mean, venture is very cyclical with rates. So like when you're a pension, right, a lot of the people the allocators that are giving money to giant venture funds are primarily giant pensions, huge allocators, hundreds of billions of dollars allocators, right? And they need a return, right? And they look at venture like a longer time period, right? These funds don't tend to pay out if they do at all for 10 years, right? So they're locking some money up. It's high risk, high reward, right? And it's part of a giant allocation strategy, right? So they're only going to put a small percentage of their investment into venture. But when rates go up, the cost of capital goes up, they can put it in treasuries and feel pretty safe, right? And so they're less forced in a zero interest rate environment. They're really forced to go out the risk curve to find ways to generate yield because the cash in their bank account generates no yield, right? So that has, and you can see this over time. If you look at the allocator interest in venture capital, it's just, I mean, exploded. It over the last 30 years, like venture was not nearly this big a deal in the U.S. economy in like pre 2000. I mean, it really took off, huge. So that's a big part of it. I mean, with the rising rates, they're not forced to chase for yield like they were in a zero interest rate environment. So you're seeing less appetite overall for venture. It's certainly not going away, but it's declining, right? So that plays a big role here as well.
Well, I've heard you kind of in the similar vein of research, but maybe in a more direct way. I've heard you speak on a panel. It was titled Bridging the Gap Between Speculation and Fundamental Value. And, you suggested that if you really want to move away from speculation to fundamentals, that you dive in, you use the protocol, you use a wallet, you really get in and do your research, even joining the Discord. Is that still the best way to learn and participate in these crypto communities? What else would you recommend?
Yeah, I mean, if you're looking to invest in crypto assets, you really got to know what you're buying, right? And these are weird, and there aren't standards for how disclosures, for example, may happen, and they're not the same. I mean, two different layer one blockchains are going to be very different. So imagine if, you look at two different equities, and they're different companies. There's going to be different cash flows and things to look at about the companies to help inform which one of them you should invest in. But like the stock certificate isn't different. Like the rails that carry the actual equity are the same, right? That's just not true in crypto, right? So you might have two different assets. Sure, they seem similar. They're both a gas token, for example, for a layer one blockchain. But the whole dynamics about it might be different, right? And not just like the token economics, the total supply, the issuance schedule, the ownership, effectively the cap table of the ownership, right? Of course, those will probably be different, but like the chain itself might work totally differently, right? And so that would be the impetus behind having to do this research, is that understanding that these are very different things. They're all very different. They might be designed for totally different reasons. So that's a very clear thing to think about. To do research. So I'd say the very first thing is understand how the thing actually works, right? And that could involve reading all the white papers or following people who develop it and understanding what they're actually building. A lot of these, though not all, and I'm very critical of those that aren't, a lot of them are fully developed in an open source manner on GitHub. So they're not just, let me clarify what I'm saying. Like Bitcoin and Ethereum are literally developed using GitHub, meaning like when there's a change that someone wants to make, they make a pull request on GitHub. There is a class of other crypto projects that claim their software is open source because they open source it, but actually it's developed in secret, and then they just dump the code into GitHub so that you can look at it. But they don't actually do the development in an open way. If you're one of those projects and you're listening, know that I'm very critical of you.
Shame on you.
Shame on you. But even in those cases, you can go and look, right? Now, I know not everyone is a developer with experience evaluating a GitHub repository, but it's not as hard as you might think. And the developers, you don't have to necessarily read the code, but there's discussion there too. So you can understand what the priorities are for the project if you start looking there.
I have, friends, myself, we've been in the space a long time. We're telling our friends, we're telling our family. And then, 8 years later, they come back to us and they say, I bought crypto. I bought Shiba Inu. And I'm like, I have been telling you for years, my friends were like, how do we get them to care about more than the memes and the marketing and really care about, the technology? I think that's one of the challenges of opening up to the masses, or getting more people to really, everyone doesn't have to fall down the crypto rabbit hole as much as all of us have, but I still want them to, care about what's under the hood.
Yeah. And I get really frustrated when I see people that get into crypto and they only buy some low quality NFT collection or a meme coin. Right. And it's like, look, if you want to go and mess around and buy a bunch of weird stuff and, fool around in these weird ecosystems, be my guest, okay? But don't consider yourself into crypto if you don't own some Bitcoin, you don't own some ETH. Don't be an idiot, okay? I tell this, I don't want to throw too much shade, but I was at an event last night in New York, and I was talking to someone who's interested in NFTs and actually build something in the NFT space. And I was like, so what? So you like Ethereum a lot? I mean, that would make sense. It's like, oh yeah, but I don't hold any ETH. I bought NFTs with it. I was like, what'd you buy? He's like, oh no blue chips. I'm like, so you sold your ETH and bought a bunch of dog shit NFTs is what I'm being told. Like, you own no ETH. You're into NFTs. You don't even own ETH. Like, it doesn't make sense to me, right? Pardon my language. So we see a lot of that. So again, there's nothing wrong with owning NFTs or meme coins or whatever, but like, it's like saying you're into technology and only buying like a penny stock of a 2-person startup. Like, own Apple, own whatever the big companies are in the technology space, right? Like, if you love technology, like, it's ridiculous to like think that
pay attention to what they're doing at least. Like, what's the cutting edge.
It's crazy to think that you're going to show up and like find, with no knowledge of the space, like broadly, and find like the diamond in the rough, like random low cap, like moon coin. Like, it's crazy. Like, just people, I don't know why. Warren Buffett was saying this on TV yesterday, actually, when he was asked about Bitcoin. And I actually thought it was pretty interesting. Basically, he blames it, and I absolutely don't agree with this, but he essentially thinks that that crypto is this giant speculative bubble that follows from a giant increase in gambling in the United States. The fact that states have all legalized gambling, that there's a get rich quick mentality that caught fire during the pandemic. Now, obviously, I totally disagree that is the only reason people buy, Bitcoin or ETH, but because I think there is genuine and powerful fundamental value. But he's definitely, when you talk about your friend that ignored your lessons for years and then bought Shiba Inu coin, like that's kind of what we're talking about.
Yeah.
You would hope that it's across the whole spectrum, right? It's like you have a big foundation of people that first touch point with the world of crypto is Bitcoin and ETH, and then you have the new shiny things that come along that bring in people that are probably the first to leave when when things go a little rough. So we're in a bear market now. ETH's
are we? Because people are
exactly.
I would love to know. Yes.
I mean, this is
no, we are.
Question. It's like I thought BAM was $83. So
I remember that in 2019. No, I would say I totally agree. Look, no shade on anyone. Buy whatever you want. Have fun. Blah blah blah. But are we in a bear market? I mean, we definitely are. I think that's a simple answer. Yes, but I think Bitcoin at 30K and ETH at 2K. I think that feels right to me. I mean, it's kind of where we when cryptos were selling off in 22. That's kind of where we settled. And I feel like that would have been strong support, but for then a giant slew of sort of idiosyncratic blow-ups happened that really resulted in inorganic forced selling, right? So you had like Terra USD, then you had Three Arrows Capital in June, and then the lenders, and then eventually FTX, right? Like all of these sort of in a row. And that pushed us artificially, right? Like down way more than otherwise we would have gone. And being back at these levels, I think just feels, we're more than 50% down from Bitcoin all-time high still. That's clearly a bear market, right? Yeah. But we're not at you're not going to see 16.5 again. That was really a rare and inorganic place for Bitcoin to be trading. And so, yeah, we're in a bear market, but I feel like people are more confident now. We know that we're not going from 16. Remember, people were calling for 12K on Twitter. It's like, dude, there's just not enough people to sell Bitcoin to get us there. Like, if everyone sold, everyone who was selling had sold to get us down to 16.5, right? I just don't see it.
Yeah, I think there's obviously a future weight to to sentiment, and so the complications of the market over the past 6 months factor into that sentiment. There seems to be a theme here, which for me is when we talk about the shiny things and the foundational value that brings others, including large institutions, into the space. We were at ETH Denver recently, where you see lots of wonderful and complicated, let's say, innovations going on. Layer 2, ZK, left, right, and center. There's some interesting KYC pieces that are going on. And, I guess my question is around how much of the intricacies of all of that need to be understood by all of those different demographics, or all of those different kinds of players. The big traditional venture world, you said, is largely left in a number of different ways. How much do they need to know about that real deep level sort of technical innovation going on to participate in the space, invest in the space, and so on?
So it's a great question. You don't need to know how like the ZK proof math works, I would say. Let's be real about that. Most won't, right? If you're an investor, for example, no matter what class of investor you are. We had a thing when I did VC, people, product, market, deal, right? Do we like the people?
Yep.
Trustworthy, smart, whatever. Do they have a good product? Right? Does it work? Is it cool? I don't know. Like it? Does it help? Is it efficient? Is there a market for that product? What does the market look like? Is it competitive? How does the market evolve over time, et cetera? And then do we like the terms of the deal, right? I mean, do we like the cap table? Do we like the documents, et cetera? Like that can be all you do, right? It doesn't have to be like, do I understand? So obviously if I'm evaluating something like a ZK roll-up startup or whatever, that's the product. The roll-up is the product, right? The ZK part of it is part of our product. Now we're going to do some work to make sure that, and to be clear, I don't actually do VC investing at Galaxy. So when I say I'm not actually the venture investors here, but I mean,
you can claim it if you like.
Generally speaking, we're going to look at the product. Now, if there's technical stuff that we feel we must understand in order to move forward, and we don't have the chops to do that, we may engage someone. We may ask someone to look at it with us, right? A technical expert of some kind. That could be as simple as me calling a friend of mine who knows it better than me and having them explain it to me. Or it could literally be, we literally hire a consultant who knows it. We pay a zero knowledge developer, a different one, to look at it with us and tell us if they like it, right? So you could need to, but you don't usually, I think when you look at L2s and ZK as the example, Dan, you got to have a strong thesis on where block space demand is, right? What does the future of block space look like? I think that's the first thing. That can get you to a world where you say, wow, we need more block space. And we think it should be like layered on ETH or Bitcoin and not just new L1s, right? Like every new L1 over again. Now, that might get you to a place where you say, I want to allocate or invest in layer 2s. Which one, right? I mean, I think technical capabilities, that matters, but I think like likelihood of usage, user experience might even matter more. I mean, this is something we've been looking at a lot. When you look at rollups on ETH, you look at Optimism and Arbitrum, which are optimistic rollups, versus the ZK rollups, which are coming. So I think they all kind of launched in most of them have launched in some kind of beta version. I think most people agree that technologically speaking, a ZK rollup is better, right? But Arbitrum and Optimism have like hundreds of thousands of users already, right? Was TCP the best packet exchange protocol for the internet? No, right? But it's the one everybody used. And so I think there is a little bit of some investors get a bit myopic when it comes to technology specifically, and they look for the best product and they disregard the market too much, right? So you have to balance. Just broadly, I mean, I think our thesis is pretty clear that like the generalized smart contract blockchain game is ETHs to lose. We said that in November 2021 in a report we wrote called Ready Layer 1. I think so. That was over 2 years ago, or about a year and a half ago. I think we still think that's true. I think and it only becomes more true with like genuinely usable and scalable layer 2s really launching and rolling out on ETH. Because you start to say like, well, ETH block space was expensive, but Solana block space was cheap. So you're like, well, there was a lot of demand. So like you can literally see this happen in the summer of 2021. You can see the gas prices on ETH spike, and you can watch them. You can look at the charts and see the transactions move to ETH. I mean, move to Solana from ETH, right? But if there's other places for that demand to spill out to that are more closely tied to Ethereum, like I think it's really, you have to really reevaluate the layer 1 thesis. Personally, I believe that. So
But as an individual, I'm trying to just keep up with it all as well. But, and I think competition is great. Like, I want there to be competition, but how many layer twos do we actually need? How many wallets do we need? I want us to have that competition to get to the best, but
I totally agree. I mean, that's why we look at that's when I talk about user experience in the market. I mean, and market dynamics. It's like you could have the great thing, but if nobody cares, then nobody cares, right? So we spend a lot of time on our team focusing on adoption metrics, right? Like the question being not how does something work, but how much is it being used, right? Like that. I think to me that's the most interesting question. A lot of the time, right? But again, we're researchers, not investors. And a lot of investors might say, well, no one's using it now, but in the future they may be, right? So that's sort of the bet that venture is making. I think from a research standpoint, I'm always in fact, when I was hiring people, when I was starting this team in 2021, one of the main questions I would ask people is how many people in the world own Bitcoin? That would be I would ask a candidate. Now there's many ways to answer that question, right? And that was again, the question wasn't how does Bitcoin work? Although I would also ask some questions about that too. But the question is how many people are using Bitcoin, right? And because if you show me that, or we take a ZK rollup or something, you tell me that there's 100 people using it. Okay, the tech could be cool, but 100 people is not enough. But if you tell me that it went from 100 to 1,000 in one day, or it went from 1,000 to 10,000, right? Then we start to get wow, there might really be something here that the market cares about. So that's what I focus on. I mean, Danielle, really, I think is adoption metrics are probably the most interesting for us.
How many people do own Bitcoin?
Good question. I prefer to use, there's many ways to do this. You could, I think I'll come right out and say maybe 150 to 200 million people worldwide. I like using surveys for this. You can look at on-chain data, but of course, one address holding coin could be 10,000 people at a custodian. Yep. Or, I have a bunch of different Bitcoin wallets, so many addresses could actually be one person, right? It's really hard to sort of get to an actual number looking at on-chain data. There's other ways you can look at surveys of exchanges, but people have accounts at multiple exchanges, right? Occasionally the exchanges will, if you literally Google Kraken number of users, now they're not a publicly traded company, so they don't have to put this out a lot, but you'll find at some point in time they said how many they had, and then you have to be okay, well that was 2 years ago. Coinbase said in their recent filing they were this, etc. You can do that, but it's not great. I actually like the classic internet and phone surveys from survey companies. Do you own crypto assets? Yes or no, right?
I'm telling you, no. If you're surveying me,
well, you got to keep it. Got to an OPSEC. You don't want that. You don't want that survey person finding your address and $5 wrench attacking you. So I think it's hundreds of millions of people.
Yeah. All right. Well, we have one, last topic and question to really tackle here. At Nayms, we are building a crypto insurance marketplace where we are tokenizing off-chain assets. I'm trying to switch to off-chain assets instead of real-world assets.
Love that, because RWA is a whole different thing in TradFi. You don't want to confuse them.
That's right. And Bitcoin and ETH are real world assets to me. So I don't want to, try to demonize.
Yeah, I hadn't thought of that. It's derogatory to crypto assets, isn't it? Yeah.
So off-chain assets, are there any other areas of tokenization of these off-chain assets that you're watching closely? I know we talked earlier about the trading takes on Galaxy Brains, where you monitor all types of assets. Do you see all these assets existing on chain eventually? Energy, oil, gold, etc.
It's a great question. I think yes. I think it's fair to say yes. I do see that. We've looked at this for years. When I was at Fidelity, we spent a lot of time trying to figure out whether the capital markets would move on chain in general. There are barriers. Obviously, I think one of the big ones you're seeing now, we wrote about this each of the last 2 weeks in our weekly research brief, where the EU has a bill moving through their parliament that would require AML and KYC be completed by DeFi services. Then last week, the Treasury Department also put out a report. The U.S. Treasury Department also put out a report saying the same thing, right? And So Uniswap can't do that, right? It's fully deployed. Tornado Cash can't do that, right? It's not upgradable. There's no admin keys. But that's not true for a lot of DeFi. And so a lot of DeFi technically could comply, right? And so they're probably going to have to. And so I think, which some people may or may not like, right? I mean, I think we've always sort of viewed, I think a lot of people, we being like crypto people, that there would be like institutional DeFi and internet native DeFi, right? And so I think you need that if you're going to have a lot of off-chain assets come on, or if you're going to see swaths of the traditional capital markets adopt blockchain technology as underlying rails. There's a great story about Wall Street called the paperwork crisis that basically in the 60s that I use to talk about this sometimes. So in the 60s, there was a huge boom in investing. It was post-war era. People were making money. It was the quote unquote good life in America in a lot of ways. Also a very tumultuous time. Obviously, you had the civil rights movement and you had the assassination of John F. Kennedy, and there was a whole bunch of crazy stuff too. But there was a boom in regular retail investing, and there was so much trading that there was tons of paperwork on Wall Street. All the broker dealers had to do tons of paperwork. They didn't have electronic settlement. Literally, if you sold a stock and another client at the other brokerage firm bought the stock, rather than just like saying, okay, well, he sold 100 shares and you bought 100 shares, let's just net it out and like update our internal stuff. They would move the certificates. They would literally like take the paper and courier it across the street in Lower Manhattan. And it got so outrageous that you can imagine there was like stock certificates left on desks. Some poor biking messenger like fell in a puddle. Like it was a huge problem. And it became such a big problem that even the New York Stock Exchange had to close every Wednesday at noon. They had to truncate the trading week to give broker dealers a time. Okay, you've done 2.5 days of trading. Everybody take a break and get your paperwork in order, right? And it was so bad, a quarter of the broker dealers went out of business. And it was this paperwork crisis that led to the creation of what became the DTCC, which is the central stock repository in the United States, right? They said, we prefer to do this in a bilateral, decentralized manner, but we don't have the technology to do that. So to mitigate that, we're going to centralize everything, right? We're all just going to move our stock certificates to the central repository. And then when client A sells at brokerage firm X to client B at brokerage firm Y, we'll just have the DTCC update that, right? So that we don't have to move paperwork around. I think that was a great solution because there wasn't a technological solution to do it directly peer-to-peer. We have that solution now, right? Quite obviously. I mean, I think if you go back and read the DTCC in like 2015 or 16 wrote like a major and incredibly powerful white paper about how they should be disintermediated by blockchain. Like that, tracking the ownership of a record is like one of the core things blockchains are good for, right? And so it's obvious in many ways that we should see more usage of public blockchain and in capital markets. The problem is there are intermediaries who benefit from the inefficiencies. There's the whole thing about how it has to be 10x better in order to like justify the investment, right? It's costly. In some cases, the blockchain isn't the thing that would solve it. It's actually something like data standards or something, right? So there's a whole bunch of reasons why we haven't gotten there yet. But I think it's very clear to most people, including the entity itself that stores the records of all of our equity ownership, that this is great technology for capital markets. So I expect to see it a lot more. It could be slow going. We're talking about a giant complex, the U.S. capital markets, right? It's not going to be like, oh, flip a switch.
Well, you told that story and it sounds like, oh, that was such a long time ago. But, at ETH Denver, hearing about the carbon credit market, it's still happening on paper. It's still, like you said, people are benefiting from the inefficiencies because they can write down the price that they bought it for and then go sell it, and nobody knows that price. And so, you're right that the technology solves it and it makes it better for maybe the end user, but not necessarily
right.
The people that need to implement the technology first.
Yeah, if you think about like international wire payments, and there's reasons why they take a little bit long, and you're like, what? That's so easily solved, right? Like the thing is that all the correspondent banks in that daisy chain, a lot of them collect like overnight float income from not delivering it, right? Like there's literal payments that are earned by the intermediaries by not sending your money, right? So, I mean, there are those types of barriers, and, but sunlight, heals all wounds, right? Or whatever. I don't know, whatever it is. Eventually that becomes clear. You had the big banks in front of Congress a couple of months ago, and they were asked point blank, why, when rates are at 4%, are you paying 10 basis points to your depositors? And they just basically had no answer. But we know the answer. They're taking that. They're earning that money and not passing it on to their depositors, right? And so, but that people have gotten wise to that now, so they're getting criticized for it, and I think you'll see it change.
I've got the image of a flash loan version of a courier jumping out the door and then getting straight back in.
Or bike messenger dropping his papers in a puddle, and it's exactly. Like, no.
It's a good way to phrase. It always comes back to what problems are we solving, and that is really going to drive adoption here. And so, it's been great having you on. I think one of the themes that I've been excited about for this conversation is what feels to me, when it comes to venture investing, you've had value move out of the application layer to some degree, and so it feels like a different kind of research is required for capital to be efficiently allocated, which you guys are very much doing. So thank you for educating the space. I have 3 very quick questions for you. The first 2 is we get our guests to rate themselves on a scale of 1 to 10 for insurance and for crypto. The missing link is really why crypto needs insurance, but also there's this broader exploration that we feel is required to really pinpoint what's coming next. So questions 1 and 2, where would you rate yourself out of 10 for insurance and then for crypto?
I'm going to go with like a 4 or 5 at best in insurance. I mean, I know a little bit about it. I don't really, it's cursory knowledge, I would say. Maybe enough to chat with someone who knows a bunch and not seem like a complete idiot, but I'm not really driving a conversation on insurance typically. I'll give myself an 8 on crypto. I mean, I think there's always more to learn. So, I know these questions are relative depending on who you might ask, but people are like, oh, you must be a 10. And I'm like, there's literally so much I don't know. And I also rely a lot on my team. Like I don't, sometimes I was someone said this, they were like, we had a junior employee and he was like, how do you know how can you talk about all this stuff? I'm like, because I read your work. It's like, I edit your content. So like, that's how I know about it.
Well, that's right. Yeah, it's the case of the more you know you don't know. I'm really enjoying everyone becoming an instant overnight philosopher as AI, bursts onto the scene, and all these sort of books throughout the 21st century have been coming out. Fascinating. So the final question from us is really, as we've mentioned, the missing link for us is to explore what may be missing in bringing forward the next wave of adoption. It seems like an interesting time to ask as well. If you could put down one thing that may be a missing link for crypto going to the next level, as we've seen it go to the next level many times before, what would that be?
Oh man, the missing link. I would say, I've been thinking a lot about the dollar and American leadership, and I think a missing link is really explaining how non-sovereign, decentralized money, in particular money, but also financial services, whatever else, what role that would play in a multipolar geopolitical world, I think is something that everyone should be asking themselves.
Mm-hmm, mm-hmm. Amazing. Well, Alex, thank you so much for your time on the missing link today. It's been a great conversation. Thank you.
Yeah, Dan, Danielle, thanks so much.
We're one step closer to finding the missing link. If you enjoy our show, please rate and review us wherever you get your podcast, and be sure to come back next month. Until then, we are the missing link.